Hello and welcome to this Fund in Focus brought to you by Livewire Markets. My name's James Marley. Today I'm joined by Bob Desmond, Portfolio Manager at Claremont Global, and we're going to be talking about their recently listed exchange-traded managed fund. Bob, thanks for coming in and good to see you.
Hi James, good to see you.
Well, let's get started. Can you tell me what is the rationale for the new fund?
I think it's just really in response to changing sort of customer demand. If you actually look at all the statistics, the flows into listed ETFs have been very, very strong. And it's really just in response to what our clients are telling us. There are clients who they want a listed ETMF. There's other clients who like the ease and simplicity of it all. There's obviously much less paperwork. I think particularly with the younger generation, that appeals to them. And there's obviously going to be a big transfer of wealth across, we all know about that coming in the next decade. So it's really just in response to investor demand, new flows, where the market's going. I think they're a terrific product.
Okay. The existing or the prior unlisted strategy has a good track record. It's been around a while. Is the new fund different, or are there any differences in terms of the strategy?
It'll be exactly the same. So it'll be the same weights, the same strategy, the same number of positions. It's just a different way of accessing the strategy, but it'll be exactly the same philosophy.
So for people who are not familiar with that philosophy, could you talk us through how the Claremont Global Fund operates? What is the philosophy for the fund?
So it's a concentrated global quality fund. I think we are somewhat unusual in the Australian market. We only have 10 to 15 positions. So if you're only going to have 10 to 15 positions, you do have to have some of the highest quality businesses around. It is totally bottom-up stock picking. We don't make macro forecasts or thematic forecasts. We exclude a large part of the market, to be honest. So businesses, we don't like leverage, so you won't see us in banks. We don't like commodities, you won't see us in commodities or oil or anything where we're required to make a forecast of the future. We don't like anything complicated. So you won't see us in things like pharmaceuticals, biotech. We don't like anything regulated. So you won't see us in anything like utilities. So where we kind of end up is global multinationals generally, and then basically specific niches, which are technology, well-known, stable technology businesses that are very profitable. So that's one bucket. Industrials, consumer brands, business services. Healthcare, we don't do stuff like pharmaceuticals, but we like what we call easy healthcare. So healthcare services, or we've got a hospital sterilization business, for example. So things we can easily understand, have a low cost to value proposition, high margins, strong cash flows, strong balance sheets. And I think most importantly, easy for us to understand and value.
Yeah. So why have you adopted that philosophy?
I think investing is like religion. There's lots of different ways to find what works for you. It just works, it makes sense to me. One of the things I like about it is it does allow you to stick the long term. If you own really high quality businesses, you don't have to stress as much if there's, when a recession's coming. You don't have to spend all your time worrying about recession, because our businesses are actually decades old. Some of them, the average is 80 years, just the average. So you know that they will survive the next recession, so you don't have to worry about that. You know that they've got earnings growth, so as they keep growing, the valuation keeps growing, the earnings keep growing. You know that they've got very wide moats, so we don't like being in fast-changing industries, because if you're in a fast-changing industry, you spend your whole time trying to predict the future, and if you get that wrong, you can get completely blindsided. So we like businesses that are very stable, growing, buy them at the right price, and just think for the long term.
Yep. And so what are the metrics that you value most in a company that will make its way into your portfolio?
So if you actually go to the Claremont Global website, you'll actually see there, and this is a bit of a cliche, but we do say own the world's best businesses. And I always at pains to stress to people there's two key words there. One is own, and the other one is business. We don't trade markets, we don't trade stocks, we don't rent pieces of paper. We think like business owners. So if you think of your own business, the things what are you interested in if you own a business? It's going to be organic revenue growth. What is the profitability? What are the margins? What's my balance sheet look like? What does my cash flow look like? What are my returns on invested capital? And what's the valuation of the business? That's what we spend all our time thinking about.
You mentioned earlier you only hold 10 to 15 stocks. What's the case for concentration?
Again, it's thinking like a business owner. If you're a business owner, you know, again, take your own business. You want to concentrate, capital is limited, and you want to concentrate your capital on your best ideas. I've never understood why you would want to have, you know, a portfolio of 15 really good stocks and then have a long tail of 20 or 30 average stocks. Why not just have a portfolio of 10 to 15 great stocks? There is a caveat though. If you are going to be that concentrated, you have to be really in highest quality businesses. So if you go and put 10% into, or 10 or 20% into, let's just say, a commodity business, and you have to make a forecast of the future, and you get that wrong, that's what I call a binary bet. But if you're in a business that we don't have to make heroic forecasts of the future, either based on the direction of the business or the valuation, that's where we like to concentrate capital.
So Bob, how is that philosophy translated through to performance for the fund?
I mean, obviously you can look at the investment performance, and that's been solid. I think over the last 5 years, 4.6% alpha. So that's ahead of our long-term target return of 8 to 12%. But it's not just that we look at. It's if you actually look at the fund, it's got an active share of over 90%. So it is clearly very active with 10 to 15 names. And a lot of investors, they say to me, oh, you know, 10 to 15 stocks, that's going to be, you know, very risky. But if you actually look at our tracking error, it's beneath 6%. So our tracking error is quite low. And that's because we do target really, really high quality, stable businesses with predictable earnings. So that's, you know, clients do say to me, oh, that's surprising you that your tracking error is so low with such a high active share. I think we perform well in down markets. You know, we do very well in up markets. So what we're really trying to do is actually perform over rolling 5-year periods. And if you look over rolling 5-year periods, we've delivered alpha in every single period we've managed the fund. So that's what we're really trying to do for clients, rolling 5-year alpha over long periods of time, but in down markets, making sure we protect capital for them.
So for people that want to find out more about your new exchange traded managed fund, what's the best place for them to get further information?
Best place would be go to our website, claremontglobal.com.au. And there's a lot of other information there. You know, we've got our investor manual there, which will help them understand more how we think about not only our investment philosophy, but also our client philosophy and how we think about clients and communicating with them. There's lots of insights. Obviously, we talk about the funds, the holdings, etc. And I think that's a good source of information for them.
Well, Bob, thanks for coming in and talking to us about the strategy behind the newly listed exchange traded managed fund of the Claremont Global Fund.
Thanks, James.